Asia and Europe, two continents, two powerhouses, each with its own financial DNA. On one side, you have the rapid rise of Asian economies, from the high-tech engines of South Korea and Japan to the financial giants of China and the booming markets of Southeast Asia. On the other side, Europe brings centuries of banking tradition, monetary integration through the Eurozone, and deep financial stability built on regulation and legacy wealth. As the global balance of power shifts, the question becomes more urgent. Who is leading the world into the next financial era? Is it the old world of Europe or the rising tides of Asia? Europe's financial architecture is deeply institutional, built on decades, even centuries, of structured banking practices. The European Central Bank, ECB, based in Frankfurt, oversees monetary policy for 20 Eurozone countries, managing interest rates, inflation, and money supply with surgical precision. European banks operate under strict regulatory regimes, such as Basel III and MiFID II, that emphasize risk control, transparency, and consumer protection. While this makes European finance relatively stable and predictable, it also slows down innovation, making adaptation more bureaucratic. Asia's financial system, however, is less centralized and vastly more diverse. You have China's state-dominated model, where the 5 largest banks are government-controlled and act as tools of national strategy. Japan, a historically conservative economic giant, holds enormous public debt, but relies on domestic savings and the Bank of Japan's ultra-loose monetary policy. Then there's India, a hybrid system pushing hard into digital banking and fintech, often bypassing traditional systems altogether. Meanwhile, Singapore, South Korea, and Hong Kong have become highly advanced financial hubs with cutting-edge tech and global reach. Asia's diversity is its defining feature and possibly its greatest strength. Europe, despite slower growth, still wields immense capital. Nations like Germany, France, Switzerland, and the UK house some of the world's most established financial institutions, including BNP Paribas, UBS Deutsche Bank, and HSBC. London, even after Brexit, remains a magnet for international investment, with trillions in assets under management. The euro is the world's second largest reserve currency, and European countries collectively control a significant portion of global wealth, especially in bonds and pension funds. But Asia is quickly catching up, and in some metrics surpassing. China now hosts more billionaires than the United States, and its sovereign wealth funds, like the China Investment Corporation, are buying stakes in everything from U.S. real estate to African mining. Singapore and South Korea have some of the largest pension and savings schemes in the world, and India's startup economy is creating new financial elites at an incredible pace. Asian countries now account for over 40% of global GDP, and with high domestic savings and large trade surpluses, they are rapidly becoming net lenders, not borrowers in the global system. Asia is at the forefront of financial innovation. In cities like Beijing, Bangalore, and Jakarta, entire generations have leapfrogged over traditional banking and moved directly into digital wallets, crypto exchanges, and instant mobile lending. China's super apps like Alipay and WeChat Pay handle trillions in transactions annually, while India's UPI system allows real-time payments across platforms, even in rural villages. Fintech unicorns in Southeast Asia are raising billions to expand digital credit, e-commerce finance, and neobanking. Europe's innovation approach is slower, but deeply rooted in regulation and security. Countries like Estonia are pioneers in e-governance and digital identity, while Germany and the Netherlands are developing green finance ecosystems that link technology to sustainability. European fintech startups are globally respected for their compliance with strict data privacy laws, especially under GDPR, making them appealing to institutional investors who prioritize transparency and ethics. While Asia races ahead in scale, Europe often leads in trust. Both continents face serious financial risks, but their challenges differ dramatically. In Europe, demographic aging is the ticking time bomb. Countries like Italy, Germany, and Greece have shrinking workforces and growing elderly populations, putting enormous pressure on pension systems, healthcare, and long-term productivity. Youth unemployment remains high in parts of Southern Europe, while inflation, after years of stagnation, is now testing the limits of ECB policy. Additionally, Europe's dependency on Russian energy and foreign trade partners has created financial vulnerabilities, as seen during the Ukraine crisis. In Asia, the challenges are broader but less uniform. China is facing a major property bubble collapse, high youth unemployment, and a slowing economy that could drag down the entire region. Japan's public debt has ballooned beyond 250% of GDP, though ironically it remains sustainable due to domestic investment. India and Southeast Asia struggle with infrastructure gaps, informal economies, and social inequality. Despite high growth rates, access to credit remains uneven, especially in rural areas. Political instability and corruption also affect financial trust in countries like Myanmar, Pakistan, and even parts of Indonesia. For decades, Europe, alongside the United States, has shaped the global financial order through institutions like the International Monetary Fund, IMF, and the World Bank. These bodies set the rules for international lending, currency stabilization, and economic development programs worldwide. European financial hubs, London, Frankfurt, Paris, have been pillars of global finance, wielding influence far beyond their borders. The euro, as the second most held reserve currency after the US dollar, strengthens Europe's voice in monetary policy discussions. However, Asia is reshaping this landscape. China's creation of the Asian Infrastructure Investment Bank, AIIB, signals a shift away from Western-led financial institutions. AIIB funds major infrastructure projects across Asia, Africa, and Latin America, challenging the World Bank's traditional role. Regional agreements like the Regional Comprehensive Economic Partnership, RCEP, deepen economic ties among Asian countries, reducing dependence on Western markets. Furthermore, China's Belt and Road Initiative, BRI, is financing railways, ports, and energy networks across continents, extending Asia's financial and geopolitical reach. This growing Asian influence reflects a broader move towards a multipolar financial world. At the heart of financial competition lies control over currency and monetary policy. Europe's euro stands as a symbol of economic integration and stability, backed by the European Central Bank's coordinated policies. The ECB's recent moves to manage inflation and stimulate growth show how delicate balancing these dynamics can be. Meanwhile, Asia's currency landscape is complex and rapidly evolving. China has been aggressively internationalizing the renminbi, RMB, encouraging its use in global trade and finance. Efforts include establishing offshore RMB hubs in Hong Kong and London, and inclusion of the renminbi in the IMF's basket of reserve currencies, known as the Special Drawing Rights (SDR). But China still tightly controls capital flows, limiting the RMB's full convertibility. Japan's yen remains a safe haven, especially in times of global uncertainty, while countries like South Korea and Singapore maintain open financial systems with flexible exchange rates. The competition between the US dollar, euro, and emerging Asian currencies could spark what some experts call currency wars, where nations competitively devalue their currencies to boost exports. Trade flows between Asia and Europe are massive and deeply intertwined. Europe is one of Asia's largest trading partners, while Asia supplies Europe with everything from electronics to textiles. The EU-Asia trade relationship supports millions of jobs on both continents, creating a mutual economic dependency. Yet rising geopolitical tensions and protectionist policies, such as tariffs, export controls, and tech restrictions, threaten this cooperation. Investment is another arena of contest. European companies invest heavily in Asian manufacturing and infrastructure, while Asian sovereign wealth funds and corporations increasingly acquire stakes in European technology, real estate, and energy sectors. Several European countries have tightened foreign investment regulations, particularly concerning Chinese acquisitions. The balance between cooperation and competition will define the future of Asia-Europe relations, whether they remain partners in prosperity or drift into rivalry shaped by global strategic interests. Looking forward, the financial race between Asia and Europe is less about a winner and more about coexistence and collaboration. Both continents face immense challenges: climate change, demographic shifts, technological disruption that require coordinated financial responses. Europe's strength lies in its regulatory frameworks, sustainability initiatives, and financial stability. Asia's advantage is scale, innovation, and growing influence in emerging markets. Emerging technologies such as blockchain, digital currencies, and green finance could become bridges for cooperation. The launch of central bank digital currencies, CBDCs, in China and exploratory projects in the EU hint at a future where monetary transactions become faster, more transparent, and inclusive. Ultimately, the future of global finance may depend on Asia and Europe working together, sharing best practices, harmonizing standards, and fostering trust. In a world of growing uncertainty, building a resilient and inclusive financial architecture is not just desirable, it's essential. Like the journey? Don't forget to like, subscribe, and hit the bell for more country stories from Time Nations. See you in the next one.